In this video, I'm going to talk about estate planning considerations for your tax-free savings accounts. And what I mean by estate planning is planning for what happens to your assets when you're no longer here. And it's a difficult topic to think about. This is actually in response to a question that a viewer left on the comment section of one of my previous videos. So if you have retirement planning or estate planning or investment planning questions as it relates to retirement, feel free to drop me a comment. The goal of this channel is to answer questions. So the inspiration for these videos comes from conversations that I'm having every day. And in this case, it comes from questions that I'm receiving from you. So if you have questions, certainly drop them in the comment section. And I'm happy to put together content that's based on, trying to answer those specific questions. So the question that a viewer asked is, how do we think about passing a tax-free savings account along to a spouse, which is sort of the broad topic we're going to talk about today, which is estate planning for tax-free savings accounts targeted at somebody who's trying to plan for passing that tax-free savings account along to their spouse. And before we get started, if you've come upon this video because you're searching for information because you've lost a spouse, first of all, my deep condolences to you. I'm so sorry for your loss. This is a very difficult time. I hope that this video is helpful to you as you work through some of the planning aspects around that transition. And so I'm going to talk about estate planning for tax-free savings accounts. I'm going to talk about beneficiary designations. I'm going to talk about the successor holder option that you have on tax-free savings accounts. And then I'm going to leave you with a couple action steps at the end of the video. But before we get started, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people with retirement, and I created this channel to share ideas and concepts that I'm using in my practice every day. If you like this video, consider giving it a thumbs up. And if you want to get more videos like these, consider hitting the subscribe button so you can get more of these videos pushed to the top of your feed. So to set the stage, let's talk about tax-free savings accounts. Just a quick refresher. So in a tax-free savings account, funds go into the account on an after-tax basis. So you're using after-tax funds to fund tax-free savings accounts. They grow inside of the account on a tax-free basis, and then eventual withdrawals are tax-free. So in addition to the tax benefits of investment growth inside the TFSA, the tax-free savings account also offers some pretty neat estate planning opportunities to make sure that your money goes to your loved ones quickly in the eventuality that you pass away. And what I like to talk about here is friction. The beneficiary designation, the estate planning aspects of tax-free savings accounts reduce friction when you're no longer here, when your loved ones are going through the transition of you no longer being here and moving your assets to your heirs. So in the case of tax-free savings accounts, there are really two ways that a TFSA can be passed to the next generation, can be passed to a spouse, and can be passed to loved ones. I'm going to talk about those two methods, and then we're going to talk about how those can be used depending on your situation. So I'm going to go ahead and I'm going to share my screen. And we're going to start with the first one, which most people are familiar with, which is beneficiary designations. So very simple visual here. Let's say Johnny has a tax-free savings account. It has $100,000 inside of the account. It's invested in exchange-traded funds or mutual funds. When Johnny passes away, or before Johnny passes away, when he sets up the account, or at any point while he owns the account, he can designate a beneficiary. So he can name his spouse, he can name his children, he can actually name anyone he wants. You can name anyone you want as a beneficiary of your tax-free savings account. Furthermore, you can change that beneficiary anytime. So there's a lot of flexibility here. So in his case, Johnny decides to name his spouse Janie as the beneficiary of his tax-free savings account. The question that I received from the viewer was around passing a tax-free savings account along to a spouse. So we're going to start with that example. So he names Janie as the beneficiary of his $100,000 tax-free savings account. So Johnny passes away, the tax-free savings account is collapsed, and that $100,000 gets paid to Janie in the form of a one-time payment. Johnny's tax-free savings account collapses. It no longer exists once the beneficiaries are paid out from the account. The one downside of the beneficiary designation, now we're going to talk about contrasting two approaches here. So I hope that this makes sense, but a very small detail here, and it can become a big detail depending on the situation. But as soon as Johnny passes away, any growth that occurs inside of that tax-free savings account between the time that Johnny passes away and when the funds are paid out from the tax-free savings account to Janie, his spouse, any growth that occurs between those two dates is taxable income to Janie. So there is the potential for some taxation to occur to Janie in the process of that passing of the tax-free savings account funds down to her via the beneficiary designation. So the TFSA collapses. Growth that occurs between the date of Johnny's passing and the date that funds arrive in Janie's bank account, they are income to Janie. But in terms of the benefits of the beneficiary designation, there are still some really great benefits here. Number one, the tax-free savings account funds bypass Johnny's estate. So they don't form part of Johnny's estate. He doesn't need to wait through the estate process Janie doesn't have to wait through the estate process to take the proceeds or get the proceeds from the tax-free savings account. So it's we'll call it a low friction option, not the least friction option. We're going to talk about the least friction option in a moment. Speed, I kind of tie in here with friction. It's efficient. Usually beneficiaries upon receiving or as the financial institution receiving confirmation that the account holders passed away, the beneficiaries usually receive funds from the tax-free savings account as a beneficiary within 30 to 60 days. So it's a pretty rapid process. And then finally, flexibility is the other benefit of the beneficiary designation. So you can name anyone you want. In this case, Johnny wants his spouse, Janie, to inherit his tax-free savings account. But if he wanted, he could name Janie as a half beneficiary of the account, and then the other 50% he could spread to his 3 kids if that's what he wanted to do. Okay, so there's flexibility there, and he can change that beneficiary designation at any point while he's alive. Now we're going to talk about option 2, which I think to me is the most favorable option or the preferred option for people that are married and want to pass their tax-free savings accounts along to their spouse. And it's a designation that's available on the application form of a tax-free savings account. A lot of people just default to naming beneficiaries, but this is a very powerful step that you can take to make this process smoother for you and for your surviving spouse. And the designation that we're talking about here is what's called a successor holder. So basically what you can do is you can name your spouse or common law partner as the successor holder of your tax-free savings account. And the best parallel that I can sort of draw here is where when a beneficiary is designated, you're passing along the cash from the tax-free savings account to that beneficiary. But when you name a successor holder, you're passing the account onto the successor holder. So basically what happens is if Janie is named as the successor holder to Johnny's tax-free savings account, as soon as Johnny passes away, once Janie provides documentation to prove that Johnny is no longer alive, she basically just becomes the account holder of that tax-free savings account. So the tax-free savings account lives on. It just is named to Janie as the surviving spouse. No new tax-free savings account room is required for Janie. And this is a big one. So let's say Janie herself has a tax-free savings account. Let's say she's maxed out her tax-free savings account. The benefit of naming a successor holder is that Johnny's tax-free savings account just combines together, or it becomes a separate tax-free savings account, but those two accounts together now are Janie's total tax-free savings account investments. But that addition of Johnny's tax-free savings account does not necessitate Janie to have any additional tax-free savings account room. She just takes over the account. She can make new contributions to either her previous tax-free savings account or her new assumed tax-free savings account from Johnny, provided she's within her limits. Like if the calendar year flips over in January of next year, she gets new contribution room. She can contribute new contribution room that she's earned, but she doesn't need any new contribution room to assume Johnny's tax-free savings account as the successor holder. So that's really, really key. And I'm going to loop back to that in a minute. There is sort of a backdoor method that you can use if you are the spouse beneficiary of a deceased spouse's tax-free savings account, so that you can combine the tax-free savings accounts together and not require additional tax-free savings account room. And I'm going to come back to that in a moment. So the first key benefit is the tax-free savings account lives on. It just gets moved over to the surviving spouse. The second benefit is no new tax-free savings account room is required for Janie. And then the big benefits here, again, bypassing the estate. We did that with this step as well. The assets in the tax-free savings account do not drop into the estate when you name a successor holder. Speed here is immediate. Like as soon as proof is provided to the investment dealer or the custodian or the financial institution proving that the account holder, Johnny in this case, has passed away, Provided that Janie is named as the successor holder, her name just gets added to the account as now the primary owner of the account, and everything just continues. And I think that this is probably, speed and friction. Like, these are, to me, having worked with people that are going through the loss of a loved one, anything that we can do to reduce the amount of steps, paperwork, administration, that mental burden, that overhead, anything that we can do to ease that process in a difficult time is a huge help. And even if you have a financial advisor helping you through this, it's always better, in my opinion, unless there's a really good financial planning reason, we should aim to try to make this process as friction-free as possible. So this is one of the reasons that I really love using the successor holder designation. So less friction, the speed is immediate. And then finally, we'll close on the backdoor method. So let's say that you have you've lost your spouse and you are the beneficiary of their tax-free savings account. And you're watching this video and you're like, darn, I wish that I had been named the successor holder and not the beneficiary, because now I'm in a situation where I have the proceeds, but I have a topped up tax-free savings account. I don't have any additional contribution room. What can I do? There is a backdoor method where you can make what's called an exempt contribution to your tax-free savings account using proceeds from a deceased spouse or common law partner's tax-free savings account. The key here is that there's a time limit within which you need to accomplish that. You need to make that exempt contribution by December 31st of the year following the year of death. So that's why I have here highlighted YFD at the bottom here. And so that's why I'm just going to highlight that year following death. But you have a time limit on doing that, but it is an option that is available to you. So you need to make sure that you take care of that. There's a form that you need to fill out. It's called the RC240 form. I'll link to that form in the description below if you're looking for it. I would advise you to work with your advisor and your tax professional to complete that form, just to make sure that you're not over contributing and you get a nasty letter from the CRA. Nobody likes to get those letters. So hopefully this is helpful. I'm going to give you now some action items. The first one is, if you are married and you and your spouse have tax-free savings accounts, the first major action item is review your designations, beneficiary designations. This is good advice for anyone, and this relates to tax-free savings accounts. It relates to RSPs, RIFs, life insurance policies, group retirement plans. Reviewing your beneficiary designations. In the event of tax-free savings accounts, if your intent is for your tax-free savings account to be passed to your spouse and have it continue to exist once you're no longer here, think about using the successor holder designation rather than the beneficiary designation for all the reasons that we just talked about. That speed, that immediate effect, the less administrative overhead, those are big benefits. But certainly talk to your advisor to make sure that anything that you're planning to change or do here, that it kind of ties in with your plan and that it makes sense for your situation. These videos, I always struggle because you want to give advice, or I want to give advice, but being an advisor for many years, every situation is truly unique. And so there's always little circumstances that you want to be careful about to make sure that you're doing the right thing. So by and large, I think that the successor holder designation for spouses who want to pass those accounts down to their or along to their surviving spouses makes the most sense. But of course, talk to your advisor, make sure that it makes the most sense for your situation. So hopefully you found this video to be helpful. If you have any questions or comments, leave them in the comments section. I get back to comments and questions fairly quickly. I put some resources in the description below, including the RC40 form and some other resources that I hope will help you as you plan out your retirement. I hope that you enjoyed this video. Again, if you like it, give it a thumbs up and consider subscribing to the channel, and I'll speak with you in the next video. Take care.